Credit risk is one of the biggest challenges faced by urban cooperative banks today. To ensure financial stability, transparency, and strong governance, the Reserve Bank of India has issued the Urban Cooperative Banks or Credit Risk Management Directions 2025. Urban cooperative banks deal with diverse borrowers, sectors, and products. This exposes them to multiple risks, financial and non financial, with credit risk being the most significant. If credit risk is not managed properly, it can impact asset quality, liquidity, governance, and public confidence. That's why RBI has consolidated and strengthened credit risk norms through these directions. These directions apply to all urban cooperative banks, also known as primary cooperative banks under the Banking Regulation Act 1949. They come into force immediately upon issuance and are backed by statutory powers under sections 20, 21, 35A and 56 of the Banking Regulation Act. Every UCB must have a comprehensive, board-approved credit risk management policy. This policy should cover credit appraisal and sanction normal review, and renewal of credit facility property valuation and empanelment of valuers, alignment with the bank's internal risk appetite. Importantly, the board must review this policy at least once every financial year. The directions strictly prohibit conflict of interest lending. UCBs cannot give loans against their own shares, cannot extend loans or guarantees to directors, their relatives, or entities they control. Require RBI approval to remit debts of directors or related entities. Only limited exemptions are allowed, such as loans against fixed deposits, government securities, or staff-related loans under defined conditions. Borrowers must clear statutory dues like Provident Fund and other government liabilities. Before sanctioning or renewing credit, UCBs must obtain declarations confirming no statutory areas. Proof may be sought if there is doubt. Persistent defaults are treated as early warning signals of financial stress. Banks must ensure that statutory dues are given high priority. To maintain credit discipline, no borrower can be financed without a no objection certificate from existing lenders. UCBs must verify whether borrowers already enjoy credit facilities elsewhere. Opening of current accounts requires full disclosure of banking relationships. If no response is received from existing banks within a fortnight, UCBs may proceed after due diligence. Loan sanctions must strictly follow delegated authority limits. Key controls include no oral or telephonic sanctions, proper documentation of deviations, immediate reporting of unauthorized sanctions, internal inspections and disciplinary action for violations. These measures help prevent fraud and misuse of powers. Credit risk management doesn't stop at sanction. UCBs must monitor end use of funds, conduct inspections of borrower assets, track early signs of NPAs, strengthen controls for stressed accounts. Diversion or siphoning of funds is treated seriously and may lead to recall of loans and legal action. Non-individual borrowers with aggregate exposure of 5 crore rupees or more must obtain a legal entity identifier, or lay. Without a valid lay, no new exposure is allowed. No renewal or enhancement is permitted. Lay improves transparency, traceability, and systemic risk monitoring. Property valuation must be conducted by independent, qualified valuers. Key requirements include board-approved valuation policy, minimum 2 valuation reports for properties valued at 50 crore rupees or above, proper empanelment and record keeping of approved valuers. This ensures fair valuation and protects the bank's capital. All security interests, movable, immovable, and intangible, must be registered with CERSAI. This helps prevent multiple lending on the same asset, improve transparency, reduce fraud and disputes. UCBs are advised to file charges on an ongoing basis. For working capital limits, borrowers above 10 crore rupees must follow the loan system, typically 80% as loan component and 20% as cash credit. Banks may adjust the ratio with proper pricing. This system improves cash flow discipline and liquidity management. The RBI's Credit Risk Management Directions 2025 mark a major step towards strengthening urban cooperative banks. By enforcing stronger governance, transparency, borrower discipline, and monitoring mechanisms, these directions aim to reduce NPAs, prevent conflicts of interest, improve financial stability, protect depositors and the banking system. For UCBs, compliance isn't optional. It's essential for sustainable growth and trust. Moonsys and Management Consultants LP, a trusted partner for SES and IFSC Excellence. A pioneer in establishing SES and IFSC units within Gift City and India, delivering end-to-end IFSC setup, operational support, and handling complaints, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university BAT, and ancillary regulations. A&D Fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF if CSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.